So I want to offer you a bet. I am going to flip this coin. If it lands on heads, your entire net worth, so everything you own, goes up by 50%. If it lands on tails, everything drops by 40%. Now, it's a fair coin, no trick, no small print, anything else like that. And interestingly, of course, when you work it out, the maths of that coin toss is genuinely on your side, isn't it? Because plus 50 and minus 40 averages out to a gain of 5% every single flip. So the question is, do you take that bet? And look, most people would say yes. And honestly, why wouldn't you? Flip that coin 100 times with a 5% edge in your pocket, and to be honest, you would just assume that you'd end up like embarrassingly rich, right? Well, you don't. You go broke almost every single time. And look, that really shouldn't make any sense, should it? It contradicts the way that every one of us was taught about maths in school. But this is the exact illusion that is like quietly hollowing out people's investments account, gutting portfolios, and honestly just confusing millions of people who are convinced that they are doing everything right. It's the most misunderstood law of money. And once you see it with your own money and your own numbers, genuinely, you can't unsee it. Look, for 15 years, I've spent all of that time working with people's money. And I can tell you that the one number that kind of everybody fixates on, so the average return, the growth rate that you see on that bit of paper, is genuinely the number that you never experience, and certainly the number that you never get to spend. So here's how it kind of usually goes, right? Someone comes into my office and meets me for the first time, and they'll sit down and they'll pull out a brochure or a screenshot of a fund that they've seen online, and they'll point to the line that says average return 10%. And they've already done the mental maths on the way over, right? They start investing like $1,000 a month for 10% a year over 30 years, and the final figure is usually obviously enormous. And it makes complete sense, because that is the arithmetic mean, which just means that you're adding up your returns and dividing by the number of years. The same way that you'd work out a kind of average test score or something like that. The trouble with that, though, is that your money doesn't behave like an average test score or an average of normal numbers. So let's look into all of this then and see what is going on. Let's say that you start with £10,000. First flip, heads, brilliant, you're up 50%. So in this case, you're sitting on 15,000, lovely. Now, second flip, tails, down by 40%. Now, the question is what's 40% of 15,000? It is 6,000. So you're actually down to 9. Just sit with that for a second. Your average return across those 2 years was exactly plus 5%, precisely as advertised. Your actual money, though, is down by 10%. And if you keep flipping, that average will stay stubbornly, cheerfully at sort of plus 5%, while your balance bleeds over time towards zero. That gap between the average you were sold and the money that you end up with has a name. It's what we call volatility drag. Volatility just being how kind of violently the thing swings up and down along the way on its journey. And this is all because wealth doesn't grow by addition. It grows by multiplication. You're not just adding your returns together, you're multiplying them one after another, right? And every loss shrinks the base that every future gain is kind of calculated on. What you actually experience is what's called the geometric mean, which is the compounded reality rather than just the advertised one. And the wider the swings, the further apart those two numbers get. Now, once you've accepted that money multiplies rather than adds, something else falls out of this whole thing that is genuinely uncomfortable, which is that losses hit way harder than gains. And of course, it does in an emotional sense, but I'm not actually talking about a feeling sense in this case. I mean mathematically, in a way that you can check on a calculator in 10 seconds. So if you lose 10% of your money, you need 11.1% to get back to where you started. Lose 50%, you don't need 50% to get back to where you started. You need 100%. And let's say you go crazy and lose 90% of your capital, which genuinely in the last few years people do. I've seen it firsthand, people chasing the exciting thing, the crypto swings, all this sort of stuff. If you do that, you need a 900% return just to be standing where you first started. 900. Not to make a profit, just to break even. It's crazy. And look, I'll be honest with you, when I started out, I was that bloke going down the list of the fund tables with my finger looking at the biggest number on that page. 5-year return, sort by descending, whatever's at the top, that must be the winner, right? That is the instinct and it's logical. And I put genuine real money behind it. I spent 2 years wondering why the graph on my app and the balance in my account seemed to be describing two completely different lives. Now, you've probably already worked out where all of this goes, right? If a big loss costs you more than a big gain gives you, then the path to wealth isn't finding whatever climbs the fastest. It's actually controlling how far you fall. And the sadness is that I have watched this happen to people far cleverer than me. And I know, which before you say is not particularly hard. So years back, I sat down with this guy, super smart guy, who had been running his own portfolio for like a decade before he even walked through my door. He had piled into high growth tech stocks, right? And his portfolio app essentially proudly told him that his average historical return was 12% a year. So we pulled up what was actually in there and what was actually going on. And the cash value of the whole thing was less than the total amount that he'd actually paid in over those 10 years. 10 years of contributions, 12% average growth. And somehow he was actually underwater in terms of the actual monetary amount in the account. He was absolutely convinced that he just had like rotten timing, but he hadn't. 1 year, his investments were up 60%. The next year, it was down 45%. And the multiplication had been quietly working against him the whole entire decade, while this app just kept telling him that he was kind of doing well. He'd never panicked. He'd never sold. He'd done everything that the textbook tells him to do. The maths just quietly got him and quietly eroded the real monetary returns over that period of time. So look, if you've ever looked at a healthy looking average of a return of a fund or whatever it might be, and a disappointing balance at the same time, and assumed that you were just unlucky, you almost certainly weren't essentially. And it gets worse than just the binary maths itself, because money isn't just numbers on a screen, is it? It's your house, your kids, whether you get to stop working. So on top of the mathematical drag, there's also a behavioral one. When your pot drops by 40%, you're not going to sit there stoically waiting for that next flip, are you? You feel sick. You check your account 4 times before lunch. And eventually, what do people do? People sell just to stop the bleeding. And in that one click, they take a kind of temporary maths problem and turn it into money that is gone for good. stepping off the compounding train at the exact moment where they need to get back 67% gain just to make themselves whole. That single decision is genuinely the most expensive thing that I try to end up unpicking in my one-to-one work that I do with people. By the way, links in the description down below if you're interested in that. Now, interestingly enough, I know where your head goes next because that's where mine went. If the big swings and the volatility are the problem in this whole thing, then why even bother taking any of it in the first place? Why not just sit in very, very, very low risk things or just in cash? Well, because cash isn't neutral either. Inflation is the only drag that's actually guaranteed. And of course, inflation is just the rising cost of everyday life. Now, inflation, it's not a risk, it's a certainty, a straight, uninterrupted line downwards. And when you think about the numbers, 3% a year doesn't sound like anything at all until you realize that it's the same pot buying you slightly smaller weekly shops every single year for 30 years. You just don't feel the crash effect of that. So the reality is that you have to take some risk to try and keep up with inflation. But what you get to choose is how you engineer it. And this is where diversification stops being some boring word that you nod along to. Most people think spreading your money around is defensive, right? A way of not going bust if one company implodes. But look at it through the geometric lens and it flips into something else entirely. It's an engine. It's the engine. So watch what happens with two portfolios that have identical average return, because this is the bit that genuinely changed how I invest my own money. The aggressive one does plus 50 and then minus 40. 10 grand becomes 9. The boring one does plus 10 and then is flat. 10 grand becomes 11. Same average, same percentage on paper. One of them has handed you £1,000 and the other has taken £1,000 off of you. And the one that paid you never had kind of a single exciting year at all linked with it. That's what holding a mix of things that don't all move in lockstep together actually buys you, right? So global stock markets, the equities, bonds, properties, because when one of them is having a nightmare, typically speaking, the other one's flat or even up. So the swings get smaller. And smaller swings means that multiplication starts working with you instead of against you. It's also why keeping your money out of reach of tax matters way more than it sounds like it should. So an ISA, which remember is just an account where whatever you make in terms of gains or dividends inside it is completely tax-free, protects that base that everything else is compounded on. Every time you hand over a tax on a gain or a dividend, you're shaving the pot that has to do the multiplying the next year. Small friction applied relentlessly for 30 years, right? Same disease as the volatility drag, just a completely different coat. So the law that nobody quietly believes until they see it in their own numbers is this: survival matters more than speed. Look, we are culturally obsessed with the fastest growth, the hottest asset, right? The coin flip that promises plus 50% returns. But wealth is not built by what you make. It is built by what you manage to not lose. That's the reality of that situation. Take the boring portfolio grinding out 7% a year for 2 years running. That is 1.07 times by 1.07, which gets you up to 14.5%. And that is nobody's idea of a thrilling story, right? Now take the exciting one. Plus 40, then minus 30. And on the brochure, that says an average of 5%, sometimes even higher than the boring one, so it looks like the better bet. In reality, it's 1.4 times by 0.7, which is 0.98. After 2 years of drama, you have less money than what you walked in with. The tortoise doesn't beat the hare because it's just some nice moral story for children. The tortoise beats the hare because losses cost more than gains give, and because the whole thing multiplies. And it does it mathematically, repeatedly, and completely inevitably. Now, all of that is very well, I hear you say, but how do you actually put this into practice and build wealth with a boring, repeatable strategy? Well, that's why I think that you should really watch this video here next, because I'm going to take you through the boring money rule that I use with all of my clients that I've seen people use incredibly effectively to build powerful, consistent wealth that isn't implicated by volatility drag. So give it a click and I'll see you there.